Hi, it's Sylvia from IFRSbox.com, and today I will be talking about the standard IAS 1 presentation of financial statements in a few minutes. IAS 1 is one of the basic standards applicable for all reporting entities because it sets overall requirements for the presentation of the financial statements, guidelines for their structure, and requirements to their minimum content. Purpose of the financial statements is to provide information about the financial position, financial performance, and cash flows of an entity that is useful to a wide range of users in making economic decisions. In order to follow this purpose, IAS 1 lists what should be included in the complete set of financial statements. Statement of financial position or balance sheet before, statement of comprehensive income, statement of changes in equity, statement of cash flows, and a note to the financial statements that reveal some information in addition to numerical statements. Statement of cash flows is covered separately by the standard IAS 7, so I will not talk about it in this video. IAS 1 then explains general features of the financial statements. Those are fair presentation and compliance with IFRS. This is fulfilled when financial statements are compliant with IFRS in all material respects. The information presented is relevant, reliable, comparable, understandable, with all necessary disclosures as set by the standards. Going concern. The company is able to continue as a going concern in the foreseeable future, at least 12 months. If not, the financial statements must reflect such situation. Accrual basis. That means that transactions must be recognized when they occur and not when the cash is received or paid. Materiality and aggregation. Each material item should be presented separately, and immaterial amounts should be aggregated with amounts of a similar nature or function and not presented separately. Offsetting. Assets and liabilities should not be offset except when offsetting is required or permitted by another standard. Frequency of reporting. Complete set of financial statements shall be presented at least annually. Comparatives. Comparative information from previous periods should be disclosed for all numbers in the financial statements and also in narrative and descriptive information when relevant. Consistency of presentation. Well, financial statements must be presented in the same way as in the previous period. Now let's see how the financial statements should look like according to the newest requirements of IAS 1. Each component of the financial statements must be clearly identified, contain the title, in this case, Statement of Comprehensive Income. Then there must be a name of the reporting entity, information whether we'll look to the group or individual financial statements, the date of the end of the reporting period or the period covered by the financial statements, information about presentation currency, and the level of rounding used in presentation of numbers. Now let's take a look at individual components of the financial statements. First, the statement of financial position. It shall contain at least the following line items: property, plant and equipment, investment property, intangible assets, financial assets except those stated below, investments accounted for using equity method, biological assets, inventories, trade and other receivables, cash and cash equivalents, and then usually under liabilities and equity, trade and other payables, provisions, financial liabilities, non-controlling interests presented within equity, issued capital and reserves attributable to the owners of parent. Some items might have asset or liability character, so could be presented in both categories, such as totals of assets held for sale and totals of assets or liabilities separately in disposal groups according to IFRS 5, liabilities and assets for current tax according to IAS 12, and liabilities and assets for deferred tax according to IAS 12. Further subclassification of these line items shall be disclosed, such as disaggregation of property, plant and equipment into classes. IAS 1 requires the line items to be presented separately in current and non-current distinction, current assets separated from non-current ones, and the same with liabilities. Basically, current means realizable within 12 months after the end of the reporting period. IAS 1 does not prescribe the format of statement of financial position. Instead, several of them are acceptable. Statement of comprehensive income has two basic elements: profit or loss statement and statement of other comprehensive income. Reporting entity may choose to present the comprehensive income into two separate statements or in one statement. As a minimum, the following line items shall be included: revenue, while gains and losses from the recognition of financial assets at amortized cost shall be disclosed separately. Then finance cost, share of the profit and loss of associates and joint ventures accounted for using the equity method, tax expense, single amount which is total of post-tax profit or loss of discontinuing operations and post-tax gain or loss from remeasurement of assets or disposal groups, IFRS 5, and profit or loss. Under other comprehensive income, reporting entity shall include each component of other comprehensive income classified by nature: share of other comprehensive income of associates and joint ventures accounted for using equity method, and total comprehensive income. Both profit or loss and total comprehensive income shall be reported in allocation attributable to owners of parent and attributable to non-controlling interests. I'd like to point out that no item shall be reported as extraordinary. This is prohibited. Also, an entity might present its expenses in profit or loss by function or by nature. Please see other detailed video on this topic. In the statement of changes in equity, the entity shall present at least total comprehensive income from previous statement, separately amount attributable owners of the parent and to non-controlling interests. Then for each component of equity separately, effects of retrospective application or restatement recognized according to IAS 8. And for each component of equity separately, reconciliation between the carrying amount at the beginning and at the end of the reporting period. Here, an entity must disclose separately changes resulting from the profit or loss, other comprehensive income, and transactions with owners such as contribution from owners, distribution of dividends, and similar. Notes to the financial statements shall present information about the basis of preparation of the financial statements. They should present also information that is not presented elsewhere and is required by IFRS or is relevant to understanding financial statements. Notes shall contain some general information about the presenter, an explicit statement of compliance with IFRS, accounting policies applied and judgments used, sources of estimation uncertainty such as assumptions about the future, disclosures on capital management, disclosures on putable instruments classified as equity, some dividend disclosures, and also number of other disclosures required by other standards. So, that was Standard IAS 1 on presentation of financial statements at a glance. Go to our website www.ifrsbox.com, subscribe to our newsletter, and get the newest IFRS articles, videos, and other stuff. And as a bonus, you can download our free ebook Short Guide to IFRS. Thanks for watching.